Hello everyone, my name is Elliot Gu. I'm the editor of Smart Bonds and Free Market Speculator here on Substack. And today I want to talk to you, just a quick note today about a key economic indicator that was released this morning, which is the Institute for Supply Management's Purchasing Managers Index for manufacturing here in the US. And I think that today's release was actually a lot more impactful than it's getting credit for in the mainstream media. In addition, I want to show you a simple little transformation, if you will, an indicator within the indicator that I watch very closely that I think is flashing a big red warning sign about the economy right now. First up, what is the ISM Manufacturing Index? Now, it's what we call a diffusion index. And basically what that means in this case is that index readings above 50 indicate an expansion in manufacturing activity in the United States, and readings below 50 indicate a contraction in manufacturing activity in the US. And historically, the 50 level is the dividing line, but the most important level to watch is actually closer to 42 or 43. So on this chart, I show the blue line is actually the headline Purchasing Managers Index for manufacturing going back to 1985, December 1985. It's a monthly indicator. I've labeled the 50 level that divides expansion from contraction in orange, and that green line you see there is actually at the 43 level. That means levels below 50 indicate contraction. Levels below about 43 have historically been a very strong indicator that the US economy is already in recession or soon will be. And you can see that here on my chart. And I've labeled all the recessions since the mid-80s. 1991, we got down below 40 on PMI. 2001, we got down to the low 40s, around 41 or so, a little under 41. 2007 to 2009, the Great Recession, we got below 35, one of the lowest levels ever recorded in this index. And even during the very short-lived COVID lockdown recession back in 2020, we got down to levels around 42, a little under 42. So that's historically been a very good indicator of recession ahead. Now, today's release, at first blush, doesn't look too bad. Back in July, the index came in at 46.8. So that's below 50, but it's not yet at levels that indicate imminent recession. And you can see that here on the right edge of this chart. Today, the consensus on Wall Street was for the index, which was released at 10 a.m. Eastern Time, would come in at 47.5, so an uptick from that July level. In fact, it came in at 47.2. Now, yes, that's a little bit below Wall Street expectations, but not a huge amount. 0.2, 0.3 variation from expectations isn't usually a huge deal for an index like ISM. And in fact, we did see a rebound from that very weak surprise July number in August, which is the most recent data. So nothing too problematic there. Overall, I look at a chart like this and I say, you know what? The indicator's been weak. We've been below 50 for all but 1 month since late 2022. So, well over almost 2 years now. So that's certainly weak, but we haven't gotten down to that sub 43 level that indicates that a recession has already started or is imminent. However, before I move on to what my special indicator I look at, or indicator transformation I do on PMI, one of the common questions I receive is, why do I even look at the Manufacturing Purchasing Managers Index at all? ISM, the Institute for Supply Management, also does a similar survey of managers at service industries, and the reality is that service industries account for a far larger portion of U.S. gross domestic product, the U.S. economy, than manufacturing industry. So why not look at services? Two reasons. First of all, we have ISM Manufacturing Index data going back to the 1950s. Services Index, they only started publishing in 1997. So we have a lot less historical data on the services part of the Services Index. So call me old-fashioned, but the more data I have, the more historical precedent I can look at, the more weight I'm going to assign that indicator. Secondly, I've on this chart, you can see the manufacturing index in blue. That's the index I showed you on the last slide as well. The non-manufacturing or services index is in orange. And what you can, and I've circled the three prominent cycles we've seen since the late 90s. The recession cycle of 01, the recession cycle of 2007 and 2009, and of course the most recent data series. And what you can see is that historically, the manufacturing index acts as a canary in the coal mine for the U.S. economy. So it usually weakens before the broader U.S. economy, and it also tends to recover before the rest of the economy. So it's more sensitive, it's more cyclical, and it therefore provides earlier signals of trouble ahead. So even though manufacturing is a smaller portion of the economy, in many ways it's a more important portion of the economy for those of us trying to determine how healthy the U.S. economy is, the trends in the U.S. economy over time. So that's why I look at the manufacturing index. In addition to the headline number, though, one of my favorite ways to use this index is to actually look at some of the sub-indices that are included as part of the monthly ISM release, and two in particular. The first one is the ISM Manufacturing New Orders Index. Okay. The second is the ISM Manufacturing Inventories Index. Now, the New Orders Index is a diffusion index just like the headline index. So levels above 50, readings above 50 indicate that the incoming pace of new orders to manufacturers. So people placing orders with manufacturers for new product is rising above 50, and it's contracting below 50. Now, new orders is considered a leading index within the ISM report. The reason being, think about it, if a manufacturer is producing a certain number of goods and they suddenly see an influx of new orders, that means they're probably going to have to increase production in coming months. So their manufacturing activity will increase if new orders increase with a couple of months lag. So it does tend to lead. The inventories ratio, also a diffusion index, levels below 50 indicate that inventories are being drawn down. Okay, so manufacturers are reducing their inventories of unsold goods. Levels above 50 means that they're increasing their inventories. So generally speaking, the best possible scenario would be one where inventories are very lean, low, and new orders start to pick up, because what that means is that not only are manufacturers going to have to increase activity levels to meet rising incoming pace of new orders, but they don't have a lot of inventory to act as a buffer. So the key transformation I like to look at, and this I'll show you how it's worked in a few prior cycles as well as right now, is to look at the ratio of that new orders index to that inventories index. So it's a ratio of those two diffusion indicators. So readings above 1 on that ratio indicate that new orders are relatively high and inventories are relatively low. That's bullish for the economy. Situations where you have a very low new orders ratio compared to inventories means that new orders are very low, and manufacturers are likely have elevated inventories, which means that new orders are going to have to pick up a lot before they start increasing activity. So what I like to do is I like to compare the headline index, which on this chart is in blue, the top line, and that's using the left-hand axis scale. And I like to compare this ratio to that. So that orange line is a new orders to inventories ratio, and then that horizontal green line marks that 1 level that I mentioned being very important. And this particular chart shows you from December 2005 until December 2010. So this is a period immediately before, through the Great Recession of 2007 to 2009, and the first 18 months or so of the ensuing recovery. And what we can see here is that in 2007, the recession technically started in December 2007. What we first saw is we did see the ISM Manufacturing Headline Index get down to about that 50 level, a little bit below, right? So it was in contraction territory, but it was nowhere near that 43 level that typically signals imminent recession, right? However, what we did see at the same time was several months starting in January, in fact, 2008, through the summer of 2008, where this ratio dipped below 1. So even though the PMI headline index was around 50, so at a level that suggests economic weakness but not necessarily recession, we saw that new orders to inventory ratio dip below 1 on several months that year. So that was a sign of underlying weakness in the manufacturing PMI index, and it did foreshadow, if you will, that big weakening in ISM PMI starting in the autumn of 2008, really September, October of 2008, when it plummeted to, as I showed you a couple slides ago, that 35 level. And it was the worst recession in the US really since the 1930s, or at least since the recession of the 1973 to 1975. You can also notice that in early 2009, right, beginning of the recovery for the economy exited recession in June 2009. We saw the PMI still in the low to mid 40s, so in recession levels, but we saw that new orders to inventory ratio spike up well over 1. And so that indicated the economic recovery that was not particularly visible on PMI was for real. Okay, so let's look at another time period. This is this next chart, this next slide, shows you the period from 2013 to 2017, December 2013 through December 2017. And over this period, there was no official recession in the United States. Now, we did see periods where economic growth weakened, but we never saw the broad-based weakness in economic activity that signals recession. And what you can see here is that in 2015, late 2015 and early 2016, the ISM PMI index, again, that's that blue line using the left-hand scale, it did dip below that key 50 level, right? And you can kind of see that here. I'll circle it for you. However, as it dipped below that 50 level, which suggested there was, rising risk of recession, we never got down anywhere near that 43 level that indicates, recession already upon us or imminent. But more importantly in this case, we never saw that ISM new orders to inventories ratio move below 1. It got down to about 1, but only for 1 month, and then it quickly rebounded right here. Let me try to circle that for you in 2016. And so the key point to note is to watch how these two indicators behave next to one another. Do you see weakness in PMI, but not really so much in the new orders to inventory ratio? That's typically an indication that you're undergoing a soft patch for the U.S. economy, but it's probably not going to morph into a recession. Now that brings me to the current situation. And here I'm showing you the PMI, the ISM Manufacturing PMI, on the top blue line again, starting in December 2021 and stretching up through August 2024, the data I just mentioned. And the bottom again is the new orders to inventory ratio, and that horizontal green line is the level of 1. And what you can see is that this indicator worked not as well, frankly, as it has in prior cycles, because we did actually see the headline PMI index fall below 50 in 2022 and into early 2023. As I said, we actually have only seen 1 month above 50 since late 2023, really continuously for 2 years. And we did see in 2022 and early 2023 an ISM new orders to inventories ratio of below 1. So that actually did signal elevated risk of recession, and we did not get a recession in 2022, 2023. I felt there was high risk, to be fair, that we would see a recession, but we did not. However, it did actually provide a useful signal that the economy was recovering. You can see here in June of 2023, the new orders to inventory ratio spiked over 1 and continued to recover. And after that, the headline manufacturing index began to recover as well. Now, I will tell you that there's no such thing as a perfect economic indicator, and neither PMI nor the new orders to inventories ratio is perfect, as the 2022, early 2023 experience illustrates. However, just because an indicator doesn't always work perfectly doesn't mean we should discard it. It's worked in this manner that I showed you in several prior cycles, including the two I just showed you in 2007 and 2009, showing the recession was likely, and in that whole 2013 to 2017 period, showing you a recession wasn't likely. In this case, what I'm seeing is the ISM headline index has slipped back below 50 to the high 40s. Now, these are levels that don't suggest that a recession is imminent. The problem I see is, look at what I've circled down on the lower part of that chart. Look at that new orders to inventories ratio. It got all the way down to about 0.88 as of August 2024, which is the lowest we've seen since the fall of 2022. So even though the PMI headline index is in the upper 40s, that new orders to inventories index tells us to be cautious here. It suggests that there's risk that PMI could weaken further over the next few months as we move through the autumn and into early 2025. Now, of course, there are no guarantees. This doesn't always work, but it's definitely something to keep your eye on. Now, my view is that right now the data is at an inflection point. The economic data is an inflection point. Right now, we're at levels that indicate that the U.S. economy is weakened a lot. That's why the Fed is likely to start cutting interest rates on September 18th. But we're not yet at levels that suggest a U.S. recession is imminent or will happen in the next, say, 3 to 6 months is what I mean by imminent. But we're getting very close. We're seeing it in the recent downward revisions to employment data, and we're seeing it in PMI and that new orders to inventories ratio that I just outlined for PMI. So how do we respond to this? Well, I don't think it's time just yet to prepare for recession. I think a lot of people think that you have to be early in forecasting recessions. You don't. Typically, the stock market will peak before we enter recession, but typically you don't see major declines in the stock market until months after the recession starts. Typically, the worst part of the bear market for the S&P 500 comes in the latter stages of recession. Much the same can be said for the bond market, and I actually think there's maybe more interesting opportunities in the bond market right now vis-a-vis the stock market. Typically, you'll actually see most sectors of the bond market perform pretty well, right, through the early stages of a recession, because the Fed is typically starting to lower interest rates as the economy dips into recession. In a soft landing scenario where the Fed cuts rates but the economy doesn't weaken into recession, you can also see many portions of the bond market perform well. As the recession gets worse, you typically see certain elements of the corporate bond market deteriorate rather sharply. Treasury bonds can perform very well in such a scenario. So what I'm doing in the Smart Bond service, we recently, in fact, in the last issue released right at the end of August, we made some important changes to our model portfolio. And we're removing our exposure to some of the riskiest sectors of the bond market when the economy weakens. And we're starting to dip our toe into certain sectors of the bond market that typically perform best actually in the early stages of either a soft landing or a recession. So these are sectors of the bond market that historically have done pretty well, whether the economy actually goes into a full-blown recession or whether it's just sort of a temporary period of weakness where the Fed starts to lower interest rates. So if you'd like to find out exactly what we're doing, we are actually offering 60-day free trials, totally free trials to the Smart Bond service, including full access to our model portfolios for a limited time. I'll put the link for that below. Otherwise, if you're not already a free reader of my Substack services, both Free Market Speculator and Smart Bonds, I'd encourage you to enter your email address and sign up below. I send out quite a lot of free commentary every week and every month, as well as I'm going to be doing more of these free video presentations to cover breaking news, economic indicators I follow, and the like. So drop your email in the box if you haven't done so already to make sure you get notified when I release a new video or a new free commentary as well. And again, if you'd like to take me up on the free trial to smart bonds, including the model portfolio, you can check out our special limited time offer below this video. Thanks again for listening. My name's Elliot Gu, and I hope you found this useful.